My funds are diversified, and because we're really diverse in things that we're invested in, from coffee companies to oil companies to ammo companies, it's all over the place, and that can trigger different emotions for different investors. So how I talk about them changes based on what I know about the investor. If you walk up to somebody and you don't know anything about them, then you don't know how your product or your investment opportunity is going to resonate with them, and you could really offend them if you're in a space that they just don't like. So take the first 30 seconds to 5 minutes to know more about them, and then tailor your pitch based on that information. The framework for successful fundraising is all about having patience and commitment to the goal. If you've never fundraised before, it's a experience, and you're not alone in it. So as you get more and more involved in the fundraising space, the fund management space, you're going to find a lot of camaraderie around you. I think it's important to remember to celebrate the wins as you go and set up milestones for yourself, because it can get heavy. I experience this too still when I'm fundraising, that when I get a check-in, I'm like, oh, where's the next one? Instead of recognizing that there's an opportunity there to start deploying, or what are the things around this capital that I can do and have impact. So just keeping a positive mindset and committed to the goal, because it's going to take some time. But there are people out there that are in the throes with it with you, and there's camaraderie there. So we don't invest a lot in tech, but the tech that we do invest in is fintech or financial tech. And this is the financial services space connected to technology. And that's just because I understand the financial services space a lot and think that there's a lot of solutions that need to be built around accessibility to financial services. I'm a huge fangirl of Sally Krawcheck. And so when I saw her speak several years ago, and I've watched Elevest get built over the years, but I saw her speak several years ago, and I just couldn't stop thinking about, how can I get involved in this beyond just using the platform? And there was an opportunity about 2.5 years ago for me to come in on their Series B round. And they were raising $50 million. I literally called her cell phone. I found her cell phone number and called her, and I said, hey, I really want into this round. And I believe in what you guys are doing. It's a huge mission of mine in general, in the alt space, in the private space, but also in traditional financial services. There needs to be a product like this, and I stand behind it 100%. And so I was invited in. They had literally oversubscribed, so I was one of the last investors able to come in. And so that was a really cool opportunity to be a part of Elevest, because now we get to build those opportunities into the other things we're doing, and we partner a lot on different things. Sally Krawcheck is a really interesting individual, and if you're thinking about, serving your clients as a fund manager, or even as thinking about what platform to use as an investor, and aligning your investment strategy with an advisor, because you have a decision to make. Are you an investor, or are you a manager of funds? And it's okay to be one or the other. You don't have to be a fund manager always. You can always support people that support you, and that goes back to the alignment thing. But Sally Krawcheck is the queen of private wealth, and her career has been really, really interesting. So it's been really cool to be a part of what Elevest is now, as they've crossed over $2 billion under management. I've invested across a lot of different opportunities, and each one of those deals had their own set of risks, and some of them more than others. And you've experienced loss there too. And it's not necessarily something you could avoid before making a decision. But I think that having the patience to maybe explore different risk opportunities and disadvantages and advantages of making the investment beforehand might have been able to alleviate some of that risk. One thing that I did learn from a couple of these losses that we've experienced, even in this short period of time, is that you really have to spend the time exploring what the second person is doing. If you're going through another individual, into a deal, you have to kind of understand where the incentives are built into those investments. Because at the end of the day, you're trusting somebody else to make a decision when you're partnered with them. So really exploring that partnership and how who's going to be affected when risk does ultimately come to the surface, and pulling those strings before you actually make the investment. It was a tough lesson to learn, but losses happen, and how can you move forward from that loss to have either a continued relationship with that person or not. Early in my career, I did smaller capital raises. So I was working on projects of raising $1 to $3 million, and then I escalated to $5, $10 million. And eventually, a few years in, I started doing $25, $50, $100 million raises. I think that the most difficult and interesting thing that I raised capital on was a tech startup, which is kind of why I don't do a lot of venture. But the tech startup space was really interesting. I mean, we're talking about 8 years ago, and we raised $28 million for a project. They built the app, they were generating revenue, and an article comes out that says Uber's doing such and such, and they just basically threw their hands up and quit. And that was kind of my, like, we raised all this capital, there was so much excitement around the project, and it was just walked away from. So there's a lot of really hard things that you deal with when you're raising capital for a project you believe in, and then the team around you kind of doesn't. So if you're going to be syndicating deals, make sure that you really connect with the management team behind that opportunity, because you're going to be raising capital for them. You're going to be the face and the people that the investors trust in the deal, whether they're looking at the management team or the deal or whatever product they're doing or the building they're building. At the end of the day, you're the person who's connecting with the investor on the capital. So really connect with what they're doing, because you're going to be responsible for that at the end of the day, whether you like it or not. Thankfully, the investors in that deal were sophisticated tech investors, so they kind of understood the risk about startups. There were a lot of really upset people. You're talking about $28 million, a lot of investors. Most of them experienced VC investors, but there was probably about 10 or 20 investors that this was their first exposure to the space, and they really needed a lot of hand-holding, like coming down from that loss. It's a lot to have to work with the retail investors, explaining risk tolerance and the different things that can happen in VCs specifically. So it was difficult, but you win some and you lose some, and getting investors to understand that is part of the job. I think that I relate to investors on many different levels. So whenever I'm raising capital for the things that I'm working on, I get to talk about a lot of different types of opportunities. My funds are diversified, so we're in everything from direct working interest in oil and gas to tech startups. And I've had experience in all of those spaces. And because I came from a diverse background, my family was in different types of businesses. My father was in financial services, but he also owned businesses before he went into traditional finance. My mom always worked in the private space. I think that just having some relatability really helps when I'm talking about the different opportunities. And because we're really diverse in things that we're invested in, from coffee companies to oil companies to ammo companies, it's all over the place, and that can trigger different emotions for different investors. So how I talk about them changes based on what I know about the investor. Never go into a conversation with an investor without understanding them a little bit. And if you're cold meeting them, or you've just met them out in the world, or you're cold emailing, try to do at least a little bit of research or listening before you start pitching. Because if you walk up to somebody and you don't know anything about them, then you don't know how your product or your investment opportunity is going to resonate with them. And you could really offend them if you're in a space that they just don't like. So take the first, 30 seconds to 5 minutes, depending on how much time you have with this person, to know more about them, and then tailor your pitch based on that information. If if you have 30 seconds or a minute with somebody, you don't know anything about them, you met them in the elevator, whatever, if you're starting up a conversation, you're in pitch mode and you're going to just pitch to everybody you meet. I mean, I would find out like what they do, what their space is, because based on that kind of information, you're going to know, okay, they've literally never invested in real estate because they're in this kind of, maybe they're a scientist or something. But you want to find out just a little bit of piece of information, what they do, where they live, maybe how old they are, and you can get a sense of how much risk tolerance they have or how much industry exposure they have just in those few questions. The differences between pitching different industries really depends on the level of experience the investor has in that space. If they've never been exposed to manufacturing, it's really bringing it down to a simple concept, getting them to understand how it ties into whatever space they're familiar with. I try to break things down at a very high level first and then get more complicated depending on the sophistication of the investor.